welcome to the Real Estate Tax Tips channel. My name is Sharon, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Recently, I've got quite a few clients asking me questions such as, well, how do I avoid paying taxes when I pass away? Some real estate investors even came to us and say, hey, like Cherry, I think I'm going to keep these properties forever, all these rental properties forever. I don't think I would ever have to worry about paying taxes because I'm never going to sell these properties. Just because you're never going to sell your properties doesn't mean that you will never have to pay taxes on the disposal of these property or deemed disposition of these properties, especially when you pass away. So a lot of people are under the misconceptions that they'll never pay tax if they never need to dispose any assets, any type of investment, but that's not the case. And this is the reason why I am doing this particular video for you, just so that you could understand the importance of having proper tax planning in place when you eventually will have to pay the tax upon death. Now, but before I get started, go into deep dive into this example that I have prepared for you. Make sure you give us a thumbs up if you find our video useful. I know it is hard to really face the fact that you have to pay tax even when you pass away, but if you find us useful, make sure that you give us a thumbs up and also subscribe to the channel, hit the subscribe button below. And with that, let's get started. So many of us have the misunderstanding that just because we pass away, we don't have to pay any taxes and we can finally escape CRA's grab. But the reality is, unfortunately, that's not always the case. It depends on how you're looking at it and how you plan for it. Now, with that, let's use an example to explain. I have a really classic situation in front of me. I have a couple, Sharon and Spencer. Both of them, Sharon and Spencer, in their early 40s, they just bought 2 rental properties. They have some TFSA, they have some money in their RSP. Each of them have some money in their respective accounts. They don't have any non-registered investment other than some cash in their personal name. So this is their net worth statement. So liquid assets, TFSA, $94,000 each. Sharon and Spencer each have $50,000 in their own RSP account. And then they also own a couple of rental properties that they purchased it for $450,000 each. So they purchased their old condo for $450,000, and so is their rental property for $450,000. So they have total asset of about $3.5 million, which is relatively good. Oh, they also own their own home at $1.5 million, and that is their own primary residence. Now, their net worth after deducting all the liabilities is roughly about $1.9 million. Not shabby at all. Now, what if one of them, Sharon, passed away? Well, if the wife passed away, what's going to happen to the wife's assets? Well, there is something called spousal rollover. So it actually automatically allows the spouse, in this case Spencer, the husband, to assume all the assets at the cost base of whatever Sharon paid for it. So let me just explain. Assuming that there is proper documentation in place. Now, for example, Sharon owns this TFSA account, assuming Spencer is being named as successor and of the TFSA account of Sharon, so Spencer is going to get that $94,000 TFSA money from Sharon's TFSA account. There is no tax implication because it's TFSA. Now, Sharon also has had this $50,000 RSP as well. If Sharon names Spencer as the beneficiary, there is also no income tax implication on this $50,000. It's being transferred over to Spencer's RSP account, so Spencer could inherit all these money, and this spousal rollover would only be available between spouses or common law partners. Now, in terms of these properties, now let's just assume one of these property is 100% owned by Sharon and the other property is 100% owned by Spencer. So if the old condo, assuming the old condo is 100% owned by Sharon, 100%, and the purchase price of this old condo at the time was about $450,000, as we mentioned earlier, $450,000. what Spencer is going to do is that Spencer is assuming the property, inheriting this property, this old condo, at $450,000, even though the property at the time when Sharon passed away is worth $800,000. So if Spencer passed away, then Spencer would have to pay tax. But at the time when Sharon passed away, because Sharon's the first to pass in our example, there is no tax implication on this particular situation because Sharon has willed everything to Spencer, and there is a spousal rollover that allows Spencer essentially to inherit a majority of these assets on a tax-free basis. Now, then you may wonder, like maybe shortly after Sharon passed away, Spencer unfortunately passed away very closely shortly after. What's going to happen to Spencer's terminal tax return? What obligation does Spencer have? Or does the estate of Spencer have in terms of income tax liability? Well, what's going to happen, the reality is that every asset that Spencer owned is going to be taxed at fair market value. So what it means is that all these assets that he owned at the time when he passed away, including the RSP, including the TFSA, including the primary residence that they shared when they were both alive, all the rental properties, they would always be deemed to be disposed at fair market value at the time when he passed away. When he passed away, let's say the properties were worth at $800,000. He would then be taxed at $800,000 minus the adjusted cost base of the property. Now, using them as an example, we can look at on screen right now the tax implication, the terminal tax return when Spencer passed away. We mentioned earlier that Spencer was able to inherit Sharon's assets at cost base. So when Sharon passed away, all the assets that she owned, assuming that she chose to include it in her will and give it to Spencer, then there is a special tax rollover, so Spencer's would assume it at cost base. But when Spencer also passed away, shortly after, someone has to pay the tax. And in this case, Spencer would have to pay the tax. Now, what does that mean? I should say Spencer's estate would have to pay all the taxes. Now, what it really means is that for the two rental properties that they own, one is the condo that Sharon owned, and the other one is the house that Spencer owned. They each bought it for $450,000. Now, both of them would be in Spencer's name. And at the time when Spencer passed away, the fair market value of each property is $800,000. So then they have to report that $800,000 as their deemed disposition price, even though they've never disposed it at the time when they passed away. When Spencer passed away, the property was still owned by him. It was not disposed of. It was deemed to be disposed of in the eyes of CRA. So the fair market price at the time would have been, say, $800,000 for each property. Now they have a capital gain of $350,000 roughly for each property. So then included that $350,000 capital gain on each of the properties, total $700,000 would both have to be reported on Spencer's income tax terminal tax return. Now, only the taxable capital gain, fortunately, the capital gain is not all 100% taxable. It's only 50% taxable, and therefore only 50% of the $350,000 would be included in Spencer's taxable income. So in this case, it would be $350,000 capital gain. Now, if Spencer and Sharon, in their lifetime, they would have claimed something called recapture against their rental income, at that point in time when the properties were deemed to be disposed of at the time when Spencer passed away, they would also have to include the recapture income from these two rental properties. Now, let's assume that each of them had claimed $20,000 on these investment properties as capital cost allowance during their lifetime. So when Spencer passed away on the terminal return, Spencer would have to include $20,000 as recapture income, all the capital cost allowance, being all the capital cost allowance added up in their tax return that they've claimed. So each of them would have to report that $40,000, $20,000, and it total to be $40,000. So note that In this particular example, Sharon also claimed $20,000 in her lifetime, and that's also being transferred over to Spencer, and Spencer would then have to report that as the recapture income. Remember earlier we mentioned that each of them would have about $50,000 of RSP in their register account, and so then that RSP is then being reported and taken into income the moment Spencer passed away, the second spouse passed away. So the entire amount, being $50,000 from Spencer's RSP and the other $50,000 being from Sharon's RSP account, the total of $100,000 is all being recognized as Spencer's income the moment he passed away. Now, if Spencer also worked during the year and there is an employment income before death of about $50,000, that's also included in the terminal return. So on Spencer's return, terminal return, last return that his estate would have to file for him, he would have to include 50% of the capital gain on deemed disposition, even though he didn't dispose the asset, deemed disposition of his rental property, being $350,000 in this particular example. The recapture income of $40,000 from his rental properties, the RSP income of $100,000, and also the employment income that he's earned before he passed away, $50,000. The year that he passed away, even though he's gone, his estate would have to pay taxes on $540,000 of taxable income. That is crazy. And the tax payable, if we apply the 2023 tax rates, would be $247,000. That's substantial amount to begin with. And what it really means is that Spencer's estate or trustee of his will would have to come up with $247,000 and give it to the government to file for the taxes. So that really, really sucks. And sometimes the process of getting the right to have access to these assets is not very smooth. It takes time, and sometimes the estate's trustee may actually not be able to access any of the cash available within his estate, and it would be hard for the estate trustee to come up with $247,000 to pay to the government. Now, as you can see, this is just a quick little dirty example that I've got for you. So in summary, if you were to pass away and you own some investment assets and there is no tax planning, essentially all of your assets in real estate or just regular unregistered account, if you invest in stock market, if you have a accrued gain on your stock investment, those would also have to be taken into account as income, assuming that you are the second spouse. Like some people may think, oh, maybe I can just continue to get married. You can continue to get married and then pass on your assets to the next spouse, and the next spouse can also continue to get married, but that's also not practical. Now, as you can see from my example, this could be a little bit of a moving target because you really don't know how much taxes you would be owing to CRA until you pass away. And how do you actually prepare for it? Now, let's just take a look at our example. Now, remember, Spencer and Sharon, when this happened, it was at the age of 40. Now, if they were to own the property, they didn't pass away. Maybe Sharon passed away first, Spencer didn't pass away until, let's say, at the age of 65. What's going to happen? Sharon passed away, Spencer continued to live on, and he lived till 65. And at the age of 65, Spencer passed away. Now, if Spencer passed away at the age of 65, we projected it out, and by the time the RSP that he had is now worth about $303,000. And he already sold Sharon's condo and paid all the taxes for it. And he still owns a rental property. Now it's worth $1.675 million. And his own home is now worth $3.1 million. Remember, his own home, even though there is no income tax liability when he passed away, there could be probate tax, which we're not covering in this particular video, but there could be some tax implication on the other stuff as well. Now this is his net worth, his net asset statement at the age of 65. He has a great net worth of about $4.9 million, not shabby at all. But how much tax would he have to pay at the age of 65 if he were to die at the age of 65. Now here is how much he would have to pay. Now assuming the rental property is now worth 1.675, he still owned the same rental property and his purchase price was still the same $450,000. Now the capital gain is at 1.225 million. Now, half of it is still taxable using today's rule, the inclusion rate of 50%. So 50% of the 1.225 is $613,000 roughly. And now the recapture income, assuming he's already taken more capital cost allowance to offset and defer his net rental income. Now his recapture income is $80,000. And also remember, his RSP has gone up in value and it now has $303,000. It's worth $303,000. Now, assuming these are all he had at the time when he passed away at the age of 65, he would have to include all of these in front of you as his taxable income. Now his taxable income at the age of 65 is $995,000. Not cool at all. $995,000 is a substantial amount to be included in the taxable income. And at the time when using today's tax rate and tax bracket, he would have to pay $491,000 of taxes. Now, as you can see, it is a little bit of moving target. Before, we are talking about just over $200,000 of tax if he were to die today. But if he waited until the age of 65 to die, he would have to pay $491,000. That's crazy. And what if he lived until at the age 100? You could imagine he would have to pay a lot more taxes, or at least his estate would have to pay a lot more taxes. The whole point is that we know that this is a moving target, and how do we apply what we know and what are the tools that we would be able to use or accountants are using to help these high net worth individuals to limit the amount of taxes that they would have to pay. Now, if you find this video useful, make sure you hit the subscribe button below, because in our next video we're going to talk about strategies to help you minimize or control the amount of taxes that you would have to pay at the time when you pass away. And so then when our next video come out, you will be the first to be notified. If you like our video, make sure you share our video with people that could use this particular information. Until next time, happy Canadian real estate investing.